Be a political bombshell, with both parties campaigning on the cost of living. Hello and welcome to special coverage of the interest rate decision from the Reserve Bank and a possible first interest rate rise since 2010. I'm Ros Giles. Homeowners are bracing for the Reserve Bank decision on interest rates and a possible increase on mortgage repayments. 3 of the big 4 banks are predicting the RBA to lift rates to 0.25%. For borrowers, that could mean paying a lot more each month for their mortgage repayments. But with inflation surging, many experts believe the RBA has no choice but to act. Well, we're live at the Reserve Bank with senior business reporter Peter Ryan, and Felicity Emmett, senior economist at ANZ, is also joining us. And with the political implications, our political reporter Jane Norman will be with us as well. But first, here's our business editor, Ian Verinder. Hi there, Ian. Big day. What are you expecting?
Look, I would expect a 0.15% rate hike, and that will take us up to the 0.25 level that the Reserve Bank generally tends to move in those kind of increments. And so we'll get to that level, and then from then on, we'll probably see another interest rate hike next month as well, immediately after the election. At
what point will we hit the peak? Where does the Reserve Bank really want rates to be, ideally?
I think the Reserve Bank would prefer not to raise rates at all at the moment, but they're being dragged into this kicking and screaming. We've got central banks around the world raising rates, and if they don't play along with that same kind of game, the Australian dollar will take a massive hit, and that could possibly lead into even higher inflation. So we're likely to see the US Federal Reserve meet this week with a double whammy rate hike, 0.5%, and all the talk is for a triple whammy next time they meet, a 0.75% hike. So the Reserve Bank of Australia simply can't be left behind in this. New Zealand have already raised rates 4 times. You've seen Canada do a double rate hike just last month. So the pressure is really on.
You say they prefer not to raise rates. Why?
Because Australian households are carrying so much debt that interest rate hikes in Australia have far bigger impact than most other countries. I think, our interest bill, our debt bill, is around about double our income. And that is really right up there in terms of world records.
Should they have moved earlier then, if inflation has been taking off with such speed? I know the rates, the last time we had that inflation number, it took everyone by surprise, really, didn't it? 5.1%.
It did, yep.
Should they have moved earlier?
Well, part of the problem is that a lot of the inflation that's feeding through is not generated at home. It's being generated by factors beyond Australia's control. Higher fuel prices, higher commodity prices in general, including food. We've had floods up in the northern part of New South Wales and southern Queensland, which have affected food prices as well. So a lot of this is being driven by supply constraints rather than increased demand out of the local economy. Whereas in America, for instance, a lot of the inflation that's being driven there is coming directly from the local economy. And that's why the Federal Reserve is desperate to try and shut down American inflation at the moment.
Is there any chance at all, Ian, that they may not move today?
There is a chance, but the pressure, as I said, is certainly on for them to do something. And the easiest way out would be to do a 0.15% hike today and then possibly 0.25% next month, which would be a 0.4% hike in the space of just a few weeks.
Ian, for now, thank you. Let's go to Peter Ryan now, who is down there at the Reserve Bank. Hi there, Peter. I haven't spoken to you for a while because rates haven't moved for a while, have they?
Well, that's right, Ros. We used to be down here on the first Tuesday of every month, except January, but rates have been static for so long. But now it looks as though they're going to be rising, and there's a little bit of atmosphere here in Martin Place, the headquarters of the Reserve Bank. And actually, the Reserve Bank board have been meeting in person here today, face-to-face meeting. Like most of us, they've been operating remotely with those important meetings throughout the pandemic. But Ros, the feeling is that rates are going to be moving up by 0.15% to a quarter of a percentage point, as Ian was saying there, and then possibly in those increments for, who knows, the next few months to really get the rates close to where the Reserve Bank would feel that they are normalised. But they have to be so careful given the exposure that Australian households have. The massive debt figures I saw earlier, that in 2021 alone last year, $650 billion taken out in new loans. So you can understand the sensitivity that new borrowers in particular have, given that we do have, in a sense, a whole generation just about of people who've never experienced an interest rate rise, and you have to go back to November 2010 for that sort of experience.
So as you say, the Reserve does have a balancing act on its hand, doesn't it, Peter? It needs to calm inflation without choking growth. At what level will be the sweet spot, if you like, to achieve that balance?
Well, it's looking as though the RBA's cash rate target could go to 1.25%, although money markets are looking at something much higher over the next 18 months, 2%. But really, the Reserve Bank has to do something today. They do have that mandate of having to keep inflation snugly within that 2 to 3% target band, as we saw last week with headline inflation for the first quarter of this year, 5.1%. That's well above that target, and also the Reserve Bank's underlying measure of inflation, or core inflation, is at 3.7%. So they would be knowing there in that meeting here in the Reserve Bank today that they need to do something, and in particular to demonstrate that they are independent of government, particularly during an election campaign that's being fought over the cost of living and also economic management.
Peter, how important do you think it is that the Reserve Bank stay the course with this kind of interest rate hike? I mean, there's been a lot of conjecture that they won't interfere during an election campaign. What's your feeling on that?
Well, Ian, I think that they do have to show that they are independent. They do have to show that they are credible, and they do need to underscore the guidance that they provide to the market and economists. And they are going to have to stay the course on these rate rises to get to a normalised level, given, as you said, what we're seeing around the world, with the US Federal Reserve likely this week to go in hard with another perhaps half a percentage point increase, and signalling more down the track. And if we don't get inflation under control here, well, the Reserve Bank will be poorly judged as being behind the inflation curve and not acting well ahead of that to try to get inflation comfortably within that 2 to 3% band.
As Peter was saying, for many borrowers, this will be the first time in that they've seen any sort of rate rise. So what sort of impact will even a small rise in interest rates have on the average mortgage repayment?
I think if you add today's potential hike and next month's, which would probably be another 0.25 next month, so that'd be 0.4 in total between the two, you'd see around about an extra $220 per month added to $1 million mortgage. Now, $1 million might sound like a lot for a mortgage, but it's not these days, given the way real estate has moved, and all driven, of course, by the extraordinary amount of debt and borrowings that we've taken on. And that's one of the key factors here, I think, that is limiting the Reserve Bank. It's why it's been so gun shy, really, in pushing these rate hikes through.
Ian, for now, thank you. Well, 3 million Australians have a mortgage, and for the first time in over a decade, rates could rise. As if expected, the cash rate goes to 0.25% today and to 0.5% in June. Borrowers will soon be paying hundreds of dollars more on an average loan. So here's the size of a typical home loan in each state. The average mortgage in Australia is just under $600,000. But in New South Wales, the average loan is $750,000, though it is much higher in Greater Sydney. So for a $750,000 mortgage, which is what plenty of people across Australia now have, if the cash rate hits 2% next May, in a year's time, borrowers will have to find an extra $767 per month. And of course, those who've deposited cash in their savings will benefit from a rate hike, but not by much. So let's assume you have $50,000 in your account. If the RBA lets the cash rate target by 2% next year, and the banks pass on that hike in full, which is a big if, savers can earn an extra $91 a month, which by most people's calculation is not that much. Well, I've got our business editor, Ian Verinder, in the studio with me, but also Ian, just pause you there for one sec. We also have Felicity Emmett, who's an economist with ANZ Bank, joining us also. Felicity, if you can hear me, what are you expecting the RBA to do in about 20 minutes?
Yeah, look, we expect that they will increase interest rates up to that 0.25% level. There is a chance that they do wait. They have said that they would have liked to have seen wages data in mid-May and early June, but I think the lift in inflation that we saw in the March quarter CPI report really leaves them not very much room at all to wait. So I think that they will start this month and then continue to raise rates over the next year, lifting the cash rate to 2.25% by the middle of next year.
Okay. So what proportion of borrowers, Felicity, are just on the edge of mortgage stress and will be pushed over, if you like, by albeit a small interest rate rise today?
Look, actually, there are not very many people in mortgage stress. We know that arrears levels are very low at the moment, less than 1%. We know that around 40% of people won't have to lift their repayments at all if the cash rate rises by a full 2 percentage points because they're paying so much more. We know that on average, borrowers are 2 years ahead on their repayments, and that's up from about 1 year just a couple of years ago. So when we look at the average or the aggregate, actually it looks like most people are going to be able to manage the increase in interest rates quite well. But there is going to be some people who have overextended themselves and that will struggle with higher rates. But we have to remember that the idea of monetary policy tightening is to reduce demand in the economy, and that's how it works, by increasing repayments so that discretionary spending is slowed, and that's how the economy will slow and inflation will get under control. So the hit to discretionary spending is a deliberate part of the monetary policy tightening.
Felicity, you talked then about buffers and the extent of the buffers, and you mentioned averages. The problem with averages, though, would you suggest would be that it masks the distribution of the buffers, that most of the buffers would be held by older Australians who'd been homeowners for quite a long time, and that the pain would really be inflicted upon the people who've actually just piled into the market in the past 18 months, really at the behest of the Reserve Bank and APRA, which opened the floodgates.
Yeah, look, absolutely. You're totally right about the way that averages can hide what's happening with some of the more marginal borrowers. But what we do know is that borrowers who have high debt-to-income ratios tend to have quite high wealth and quite high liquidity buffers. So many of them will be insulated to some degree. And also we know that in terms of people being forced to sell their home, that's normally not because of high interest rates. It's normally because people lose their job or they have a relationship breakdown or because they've become ill. We have to remember right now that we have the unemployment rate at 4%, the lowest since 2008, and before that, the lowest since the early 1970s. So many people have a job. They have the ability to repay their loans. Banks have been required by the regulator to use a buffer of 2.5% until November last year, and then since then 3% to determine serviceability of people's mortgages and how large those mortgages should be. So people should have that ability and that capacity generally to afford increases in interest rates. And when we look at how much someone will pay on their interest bill, even if interest rates go up by 2 percentage points or so, as we expect over the next year, in terms of the share of their income that they will be using to service that loan, to service the interest payments, it will only go back up to pre-COVID levels. So that should be quite manageable.
So that said, Felicity, what would interest rate rises and a rising interest rate environment do to house prices?
Well, it means that people can borrow less and so they can spend less. And so that does mean that we're likely to see house prices decline just because that demand will be lower. So, I mean, just as we saw through the past couple of years, as very low interest rates lifted asset prices, that was part of the monetary policy mechanism. This time round, we're going to see higher interest rates, and part of the monetary policy mechanism is the way that feeds through into asset prices. It lowers asset prices. People will feel slightly less wealthy, and so they won't spend quite as much, and that's how that will slow demand in the economy and reduce some of those inflationary pressures. And that is what we would expect. The RBA's modelling shows that that they expect, prices to fall about 15% in real terms. That's only about 10% in nominal terms over the next 2 years. That is something really that should, again, be relatively manageable when you think that prices are up nearly 30% or so over the past couple of years.
OK, Felicity Emmett from ANZ for now. Thank you.
Thank you.
Just a reminder, you're watching special coverage of the interest rate decision from the RBA, which is due to happen in just under 50 minutes' time. We'll bring you that decision live. Of course, rates are expected to go up, but we'll know at 2:30 exactly. More on the political reaction to today's decision. Let's bring in Jane Norman, who is in Parliament House in Canberra. Hi there, Jane. So how are the two leaders framing their arguments ahead of this decision today?
Very carefully, Ros. I mean, neither party really has a plan, or neither party can address the global events that have sent inflation soaring here in Australia, from the war in Ukraine, the supply chain issues, and of course the massive amounts of government spending during the pandemic. But what they are offering voters during this election campaign are kind of modest plans to help Australians make ends meet. So that is what the two have focused on today. Labor has laid out policies that it says will reduce the cost of childcare, will keep power bills down and make housing more affordable. And of course, in this debate today, housing affordability is where I suppose rising interest rates are felt most acutely. The coalition has already cut the fuel excise. It's handed out cash to low-income earners and pensioners. But today, Scott Morrison was kind of zooming out a little and saying that it's the coalition's shield. That's what he's calling it. Its economic plan that's managed to shield Australians from the worst of these global events. And he's noted that some Australians, or many Australians in his words, have already started preparing for a potential interest rate increase. Here's what he had to say.
Because Australians know the pressures that we're facing here in Australia are real. They are overwhelmingly being determined by things beyond Australia, and what they do know is our government has put up an economic shield for Australians, Australian businesses, Australian jobs, Australian incomes to get us through one of the worst crises we've seen in generations.
Well, the Labor leader Anthony Albanese has countered that, saying what voters are actually facing at this election is a potential interest rate rise. They're already experiencing the cost of everything going up in terms of cost of living. All the while, wages growth has remained stagnant, the so-called triple whammy that Labor's been referring to. Here's what he had to say.
You have said that under Scott Morrison's watch there would be a triple whammy.
Yes.
Interest rates would rise today. So under your
I haven't
watch,
said interest rates will rise today.
Said
I've said the Reserve Bank are
interest rates rise
responsible.
today, it would be a triple whammy under Scott Morrison's watch.
It is just is just a fact.
Under your watch, then, would it not be a whammy if interest rates rise?
And under our watch, what we have is a plan to reduce costs of living on working families.
Jane, will know the decision soon enough, of course, but how rare is it for there to be an interest rate hike during an election campaign?
So rare, Roz. You've got to go all the way back to 2007, so over a decade ago now. That's the last time an interest rate rise happened in the midst of an election campaign. At the time, the rates were increased to 6.75%, which was an 11-year high, and this really hit the Prime Minister at the time, John Howard, because he'd made a promise to keep interest rates down. So that RBA decision sent shockwaves through the election campaign, and it had an impact. And of course, Mr Howard went on to lose the 2007 election. So Scott Morrison would be hoping, of course, that this is not a bad omen for him. But even before today's decision, whatever it may be, the economy has been absolutely front and centre of this election campaign. Cost of living is of three words that you hear endlessly day in, day out. And so at a time when the price of everything is going up, after 2:30 today, perhaps some mortgage holders will also see their mortgage repayments go up too. So it's not good timing for a coalition government that is basically pitching to voters that it has the best plan for economic management. And I think if you look at previous campaigns, parties will tell you that when we're talking about the economy, economic management, that is traditionally a good thing for the coalition, which sort of frames itself as the better economic managers. Well, given these kinds of events, Labor is hoping that at this election it can turn that orthodoxy on its head.
Jane, thank you. Well, the decision could have wide-ranging impacts for thousands of Australians. Bashir Naim is building a family home in Western Sydney on a variable mortgage. He's taken out a larger loan than expected because of the cost of building a new home. They're soaring.
I think I've always gone with variable just because, we've been taking out loans for the last 10 years and we've never been in a position where things have gone up dramatically. So you kind of get accustomed to low rates in general. If they do go up dramatically, I think there's going to be a lot of people in trouble, not only us. We're probably in not a bad position, but it's obviously scary not knowing how the future's sort of heading. You have to sort of deal with things, and I think the way to deal with this is to sort of see other areas where you can sort of manage your money. I think in the last couple of years, I think everybody's been just spending because, during COVID, that was the thing you did and keep you busy. And I think unnecessary spending will probably be cut down for sure. It sort of stops you in your tracks a little bit because we've never sort of had that. It's always been, the rates are dropping and, the housing market's booming, and all of a sudden it's on the other way down. So it sort of stops you in your tracks a little bit, that's all.
Let's bring back senior business correspondent Peter Ryan now, who's outside the RBA building in Sydney where it's all happening. Hi again, Peter. So if the RBA decided not to raise rates, what would be the key reason?
Well, as we were hearing just then, the rising cost of living, and we're yet to see real wages growth to counter rising inflation and what's likely to be higher mortgage repayments. Now, in previous statements, the Reserve Bank Governor, Philip Lowe, has said he wants to see evidence of wages growth, not just signs of wages growth, and they've said that consistently, but they've also said they wanted to see signs that inflation is back in the 2 to 3% target band. Well, it's well above that. So if there was going to be a reason for holding back today and then going in June, is that they want to wait and see the wage price index data, which hits on May the 18th, just a few days out from the election. Now, that would, according to some economists, would seem to be a bit of a feeble excuse, given that controlling inflation would be the overriding issue in this monetary policy decision. But there's no doubt that the lack of wages growth is a real concern. People are paying more. Supermarket shopping has become bill shock. Petrol prices are rising, and even though there's that cut in the fuel excise, that's really not doing that much to help people's household budgets. So what happens with wages growth is going to be critical, whether or not wages go up, whether or not the interest rates go up today or in June.
What sort of figure are we expecting on that wage number as things sit now, Peter, and what could start to push it up?
Well, wages have been sitting around about 2.3% growth very sluggish for the last few years. It's been a huge challenge to get, wages pretty much off the ground, given that they've been just above flatlining. The federal budget is counting on wages, rising, and that's going to be assisting in Treasury coffers, because if wages are rising, that's going to mean more tax. So there are multiple moving parts here, but there are parts of the economy where wages are up. If you just go look around cafes and restaurants, very hard for operators to get staff. They're having to pay big dollar to get people in. So there are some parts of the community who are seeing wages growth, but in broader terms, particularly for people in full-time ongoing jobs, that wages growth is not really there, and to many people probably listening to this would say that wages growth does appear to be elusive to them.
And whenever there's a rate decision, the Reserve Bank releases a statement to go with it. How important will that be on this occasion to knowing what their thinking is and where things go from here?
Well, the Reserve Bank, I'd have to say, they've improved their communication somewhat over the last couple of years. We'll generally see the main decision on the cash rate target right at the top of the statement. It used to be the final thing that they would said, so we would always read from the back of the statements, but no longer. But it will be critical to read the language, the reasoning for raising rates, if in fact they do that, or the reasoning for holding off. And very, very important changes in monetary policy guidance, even small tweaks in language or major changes in language will really set the market up, in particular for how many more rate rises we'll be seeing further down the track, maybe over the next year, even 18 months, but also the level of those rates, and also where the Reserve Bank wants to finally get to, where they would regard the cash rate as being neutral. After the global financial crisis, I think it was the neutral rate was seen as around about 4.5%. That's a long way away. That's ancient history now. We won't be seeing rates go as high as that because of that level of household debt, and the economy couldn't handle it. And of course, as what we're seeing in the United States is there are some concerns that aggressive rate rises could push the United States into a recession. So central banks have to be very, very careful about the ferocity or how aggressive they are in rate rises.
Okay, Peter, you're going to be the person to bring us the news from the Reserve Bank when that decision is announced in, 2.5 minutes' time. We'll talk to you then.
Okay.
But now let's bring in, again, our senior economist at ANZ, Felicity Emmett. Hi again, Felicity. So with rates heading higher, as it looks they are, what should people do in terms of getting a fixed or a variable mortgage? I mean, locking in a fixed price, if you haven't done so already, would seem to be the best option, wouldn't it? And how many people have done that already?
Well, we've seen a lot of people go into fixed rate mortgages over the past few years. Normally, month to month, about 15% of people go into fixed rate mortgages. But at the peak, just a few months back, there was about 50% of new loans were going into fixed mortgage loans. Now, that has dropped away. We've seen quite a significant increase in fixed mortgage rates. They are driven more by market pricing. We've seen that market pricing change quite significantly because of what's happening overseas and because of the end of the Reserve Bank's term funding facility. And that has meant that those fixed rate mortgages are quite a lot higher now than variable rates. And so most people now would probably be opting for that variable rate and taking the risk, I think, on what might happen with the cash rate, because, you know, there is quite a lot of uncertainty. We know in terms of the world, as Peter just said, we've got the Fed raising rates very aggressively, potentially leading to a sharp slowdown in the US. We've got a lot of uncertainty around geopolitics. So even though the RBA will start hiking today, and it's likely that it will hike in a fairly rapid sort of few months of rate increases, there is still a lot of uncertainty around how things play out. And also, as we know, and as you just talked about, you know, there is a lot of uncertainty around wages. You know, for inflation to be sustainable in that 2 to 3% target band, we need wages to pick up, and that we haven't got a lot of evidence of that so far, but hopefully in May and early June we'll get more evidence around that.
All right, we'll leave it there with this interest rate decision imminent. For now, Felicity Emmett from ANZ. Thank you.
Thanks, Roz.
So we are standing by for the RBA to hand down its interest rate decision, which is expected at any moment. And our senior business correspondent is at the Reserve. He's standing there in Sydney. And Peter, what can you tell us?
Roz, the Reserve Bank board's increased the cash rate by 25 basis points to 35 basis points. So that's quite a surprise. As we were saying earlier, it was looking like it was going to be 15 basis points, but they've supersized that, taking the cash rate to 0.35% or 35 basis points. So just looking at some of the early comments, the board has judged that now is the right time to begin withdrawing some of the extraordinary monetary support that was put in place to help Australia's economy during the pandemic. The economy has proven to be resilient and inflation has picked up more quickly, perhaps an understatement, to a higher level than it was expected. But also a key line here that wages growth is picking up. And so the RBA Governor Philip Lowe is saying that given this and the very low interest rate, it appears time and appropriate to start the process of normalising monetary policy conditions. So a bit of a surprise there, not a surprise that they've risen rates, but the level that they've taken rates to, 35 basis points up, 0.25%.
And there's a media conference from the Reserve Bank, I believe, at 4 p.m. Eastern this afternoon. It's pretty unusual for them to do that, isn't it?
They've done it a couple of times. Roz, there was a press conference that Philip Lowe did last year when he started easing some of the monetary policy support. And then, going back to March 2020, when the pandemic hit and the interest rate cutting began in quite a dramatic fashion, Philip Lowe held a press conference there. So it is unusual. It's very good just to see the Reserve Bank communicating much more, but clearly Philip Lowe has some important questions to answer and to put today's rate rise decision into context and to explain the reasoning behind it.
Okay, let's go to our business editor Ian Verrinder in the studio now. So in interest rates now at 0.35%. You surprised?
I am, because it's an unusual number for the Reserve Bank to settle upon, because normally they move in increments of 0.25%, and so they like that 0.25, 0.5, 0.75, 1. So to end up at 0.35 would suggest at some stage they'll have a 15 basis point hike or reduction, depending on what happens. I mean, the Reserve Bank of Australia is very slow off the mark to be hiking rates. In New Zealand, rates are well above 1% at the moment, and we've seen 4 hikes in New Zealand already. We've seen them in Canada, the UK, the US. It is, so we are really, really very slow off the mark here. But it is a surprise to see them do that kind of level of hike.
It'll surprise the markets as well.
Yeah, I'd say so. We're likely to see a much stronger Australian dollar, and probably the stock market take a bit of a hit this afternoon.
Where will things go from here then? Let's talk about June.
Yeah, well, the thinking is that there will be another rate hike in June, and all the talk was that the Reserve, this is up until about Monday last week, all the talk was the Reserve Bank will not interfere in the political process, won't interfere during an election campaign, but not taking an action is an action in itself. So to not move today could have been considered to be political interference as well, by supporting the government not hiking rates when they should have done in the middle of an election campaign.
Yeah. You're not wrong about the reaction from the Australian dollar. It's at 1.3%, and the ASX stock market is down 0.5%. Let's bring in our senior economist at ANZ now, Felicity Emmett. Felicity, your thoughts?
Surprising that they went for slightly larger rate rise than we expected, but also bringing the cash rate up to that 0.35, which is unusual for them. It means that to get it back to those sort of 0.25, 0.5, they're either going to have to do a 15 or a 40 basis point rate hike at some point. But I think what it does show is how concerned the RBA is around what's happening with inflation. They note in their statement that some of this is obviously coming from offshore and some of the overlapping supply disruptions that we've had, but also now that they really are starting to see in their own liaison with businesses that we are getting wages pressures coming through, coming from when people are moving jobs or as businesses try to retain staff, and that is coming through and sort of feeding into what was initially a supply chain issue. And they are obviously, I think, concerned about what inflation is doing and the momentum behind it at the moment.
Felicity Emmett from ANZ, thank you so much.
Thank you.
Well, for the political reaction to today's decision, now let's bring in our political editor, Andrew Probyn. Andrew, what does this mean for the election campaign?
Well, I think what the Reserve Bank today has done is issued it's a statement of intent. It's quite clear that by year's end, interest rates are going to be much, much higher. There is going to be perhaps a back-to-back increases over the months ahead. So what it does, it sharpens that focus on the cost of living contest, which is wrapping in all sorts of things from childcare to housing to pharmaceuticals. But now it's about what do the two sides of politics have to offer in a high inflation, higher interest rate world, and that's going to be the contest, because economists, and as we can see in this very ugly chart that Ian Verinder can better explain than me, there's a whole bunch of economists who reckon that we could have the cash rate something like 2.5% by the end of the year. Now, there are reasons why the Reserve Bank might not go that high, indeed, and Ian could explain that. But the point here is that you've got a lot of people who are very highly leveraged. You've got an average mortgage in Sydney of about $800,000. If it goes up much higher, you're going to have people who are going to have to pay thousands of dollars extra every year, and if it goes up a full 2.5 percentage points, is 2.5%, as this chart suggests, then you would have people paying $1,100 extra a month. But politically, this is a bit tricky for the government. It's not ideal, but it's not unexpected either, because interest rates couldn't remain so low for so long.
Andrew, we seem to have a government and an opposition, for that matter, splashing cash around at the moment, right at the point where the Reserve Bank is trying to take cash out of the economy. This is what happens during an election campaign, I guess, but it would appear that both major parties are acting in opposition to the wishes of the Reserve Bank.
Absolutely. The low and middle income tax offset, there's another payment of that's coming sometime in the 3 months between July and September. $1,500 going into the pockets of 10 million Australians. Now, how can that not be have an inflationary impact? It's being spruiked by the government as something that recognises the cost of living pressures. That might be the case, but it also does put pressure on inflation, which is uncomfortably high at the moment. And this would be the concern, not just within the Reserve Bank, but also within Treasury, and perhaps explaining why the government in the budget took some measures that went to cost of living, but didn't go or spend as much as maybe the politics suggested it would.
Andrew Probyn there in Canberra for now. Thank you. Let's go to our senior business correspondent, Peter Ryan, once again in Sydney. Peter, you've had a bit of time to absorb that statement from the Reserve Bank. What are they saying about future rate rises?
Well, Ros, right at the end of the statement, there are some key words where Philip Lowe says the board is committed to doing what is necessary to ensure that inflation returns to target over time, and, quote, this will require a further lift in interest rates over the period ahead. Now, this is going to be quite a challenge, because the Reserve Bank is seeing inflation perhaps picking up to 6%. So there's quite a task to pull inflation, that's headline inflation, back down to that 2 to 3% target band. Dr. Lowe is saying that he thinks that this will come down once the supply constraint pressures ease that we've seen as a result of the pandemic, but it's going to be a big challenge, and I think that anyone out there who's highly indebted with a variable mortgage rate should be factoring away additional payments, because we can see additional rate rises much further down the track.
What do they say about wage inflation, though? You're talking about how important that will be when it comes out next few days before the actual election.
Yeah, well, quite optimistic about the outlook for wage growth, and the statement saying that the Reserve Bank's own liaison with the business community is showing that wages are ticking up. So that ticks the box for the Reserve Bank on evidence out there, probably not 100% evidence, but evidence out there that wages are growing. And there is a target of wages growth getting over 3% by the end of the year, if you believe the forecasts in the budget and the Reserve Bank's own targets. So that is optimistic, but with that wages growth there, they need to be acting to pull that inflation down, because the possibility of 6% headline inflation, that's getting very, very close to what we're seeing in the United States, which is actually well over 8%. So there's a very big task ahead for the Reserve Bank.
Peter, that talk about wages, that's a real departure for the Reserve Bank from previous statements, and we haven't really seen the numbers come through to justify that kind of talk.
No, we haven't. We haven't actually seen those numbers, Ian. And wages growth, or the lack thereof, really has been that big talking point. Or, as I said a little while ago, would have been the one big out for them not to do anything, to wait and see to get that evidence. So they do feel more optimistic that wages growth is out there, although I'm sure there are a lot of people out there who are waiting to see that in their pay packet, but they're looking further down the track to see that is there. And so if the wages growth is there is hope that people will be able to have that additional money in their pay packet to handle those higher interest rates, which I should point out that anyone who has a mortgage should have been judged to be able to withstand a 3 percentage point increase in bank mortgage rates. And banks have had to do a lot to repair their reputation, which was trashed during the Banking Royal Commission, and so banks are exposed here as well to ensure that borrowers do have the ability to repay what quite hefty loans. And it's really not uncommon to hear about people with $800,000 or $1 million loans that are quite vulnerable if someone loses a job or there's a divorce or a marriage breakup.
Peter, thank you. We just let you know that at 3 p.m. Eastern, the Shadow Treasurer, Jim Chalmers, is due to make comments about this interest rate rise. Rates now sitting at 0.3%. The election, of course, has all been about the cost of living, so this rate rise is going to be grist to the mill for the Labor campaign. Let's find out how the markets are reacting to the decision. Business reporter David Chow joins us now. Hi, David. So what are the top figures?
Hi, Ros. So before the interest rates decision from the Reserve Bank, the market was sitting pretty much flat, but it's had a downward reaction, quite a negative reaction to the RBA hiking rates, a bit more than expected. So the ASX 200 right now has fallen by 36 points, or down 0.5%, sitting at 7,310 points. The All Ords, the broader index, has also fallen by a similar margin, down 0.5%, sitting at 7,583 points. So it's interesting that the financial sector is one of the worst performing sectors, down 0.7%. You'd expect that banks would benefit from an interest rate hike. They do. NAB and ANZ, two banks, are releasing their financial results later this week, and they're expected to disclose some negatives, some pressure on their net interest margins because of intense price discounting in the home loan market. But when you move beyond this week and for maybe results at the end of this year, things should improve remarkably, because because banks or financial institutions benefit greatly from higher interest rates because they can charge out more to customers and raise extra revenue that way. Now, when we look at the Australian dollar, that's the other part where there'll be a reaction, and there was also a strong reaction, but upwards this time. So the Aussie dollar climbed as high as 71.4 US cents after the RBA rate hike. So that's up about 1.5%. But since moderated a bit, some of the excitement has come off. It's still up by a very strong 1%. So right now, the Aussie dollar sitting at 71.2 US cents. So it's bounced back from its 3-month low, which it was sitting at yesterday and this morning.
David, thank you.
No worries.
The ABC political editor Andrew Probyn is still with us in Canberra and joins us once again. Hi, Andrew. So the coalition has been putting the high cost of living levels, which is what the election has been all about. They've been putting it down to international pressures over which they say they have no control, rather than down to their domestic economic policy. Is that message hitting home?
Well, it's the message that they're attempting to hit home. They're talking about the war in Europe, the COVID supply issues that have been affecting the globe, and also the remnants of the pandemic. The government and the Prime Minister in particular has been talking about the fact that the government has provided the shield to some of the worst excesses, the recessionary pressures that we experienced during the pandemic. It's pointing to that experience and that experience that all Australians have witnessed with the use of JobKeeper, other sorts of supports for the economy, saying that given that we saw the economy through, we've got unemployment down to 4%, stick with us because we're in choppy waters ahead. Now, the Labor Party is saying to the contrary, that it can offer those real relief measures and cheaper childcare, lower power bills, and also its housing policy, which was announced during the weekend. So there is a contest there about trust fundamentally, and Scott Morrison is using the word shield, both as reference to what happened in the past, but also in reference to the cost of living measures in the budget, which weren't as great as perhaps some expected. As I said before, the politics of the pressures, especially the inflationary pressures, meant that the government had to be very, very careful not to push inflation very high. Now, the government insists that inflation won't be pushed too hard, if at all, by the budgetary measures, but there's no doubt that the low and middle income tax offset, $12 billion sloshing around in people's pockets, will have an inflationary effect, but that is somewhat offset by the fact that fuel excise has been slashed by half, and the budget papers said that that was going to reduce inflation by 0.25%. Now, I'm not an economist. Ian Verinder can tell you whether that passes muster, but that's the political argument.
Andrew, the amount of stimulus that was pumped into the economy by the government, around about $343 billion in terms of economic and health spending that essentially got us through the worst of the pandemic recession. But that money is still in the economy. It's still coursing through the economy. And of course, the Reserve Bank cutting rates to 0.1% and printing around about the same amount of cash. These are the inflationary forces that are sparking up the rates that we're seeing now, the inflation rates we're seeing now. Has the government made any mention at all about the impact of its own spending during the pandemic on the situation that we're currently facing?
No, not really, and neither side has really talked about that really big problem that we will have after May 21, and that is, when do we start riding the ship? When do we start paying off some of that $1 trillion debt? And these are some of the hard questions that neither side has offered. Instead, they've both been offering trinkets when it comes to cost of living. But the big question for younger Australians, those who perhaps aren't in housing, those who do face protracted wage stagnation, is, are they going to be expected to pay off this debt? And the answer there is yes, because there's no plan from either side when it comes to paying down that debt. In fact, the goals have shifted from Josh Frydenberg in the space of 18 months. It used to be that when unemployment was comfortably below 6 and then 5 and then we got to 4, we would start seeing some of this debt being paid off. Both sides of politics are simply saying we need to get the economy growing and therefore seeing that debt shrink in comparative size. But that's no answer to actually having to pay it off, especially when interest rates on that debt will increase as much as households' debts on their mortgages.
Thanks, Andrew. Our senior business correspondent Peter Ryan joins us once again from outside the Reserve in Sydney. Hi again, Peter. The Reserve can put rates up, as they have, but mortgage payments only go up if the banks pass that on to customers. When are they likely to do that?
Well, Ros, I've just been checking my emails and haven't seen any sign of rate rises from the commercial banks just yet. In the past, you've seen this happen, within hours, almost immediately, sometimes within days. But I would imagine that the banks are going to be very cautious and will have been strategising about how they lift rates after such a long period of flatlining and rate cuts, and that's going to be important. So we'll have to wait and see. It wouldn't be surprising to see some announcement from commercial banks this afternoon, but probably more likely tomorrow once the news is absorbed.
Have banks normally reacted to?
They react in different ways, Ros. Usually if there's a rate cut, they take quite a bit of time to pass that on. But if there's a rate hike, they're usually pretty quick off the mark to pass that through because that affects their profitability. And so I'd expect this afternoon we'll see some announcements from the Big Four. If not all of them, at least most of them.
So what's the overall situation? We spoke earlier about just the sheer level of household debt. The housing market, albeit it's coming off the board slightly, it's been running hot. I mean, we're not in the same situation as we were facing during the financial crisis, are we, or are we?
Look, one of the reasons why the Reserve Bank and the banking regulator allowed so much lending for housing during the pandemic was what's known as the wealth effect. So if house prices are rising, people feel wealthier, they spend more money, that gets the economy moving and it creates jobs and it gets you out of a sticky problem. But the reverse is also true. Once housing prices start to come off the boil, people become a lot more cautious. You've now got interest rate rises coming through. So they're going to be spending less money particularly on non-essentials. And so you'll see an economic slowdown, which is clearly what the Reserve Bank wants because it wants to take the heat out of the economy. But we are going to see a lot of the pain inflicted on those people who were pretty much encouraged to jump into the housing market, in the past 18 months on the pretext that interest rates would not rise until 2024. Now, we're a long way short of 2024 and we're looking at a massive series of rate hikes. And I'd bet that meeting today within Martin Place, there was a lot of discussion about what kind of impact this is going to have on first home buyers, and there are a lot of them who really jumped into the market there, who are encouraged to do so and who are now facing a lot of pain.
Let's go back to Peter Ryan, who's outside the Reserve Bank once again. And just to recap what's been going on, interest rates have gone up more than expected. They're now sitting at 0.35%. Your final thoughts before we head off, Peter?
Oh, look, I'd just add to what Ian said just then. The guidance from the Reserve Bank about rates most likely not moving until 2024 would have encouraged so many people to jump into the market. And as we saw last year and early this year, that fear of missing out and people queuing outside apartments and homes, paying unrealistic prices, going to the limits of what they could afford. So the guidance from the Reserve Bank is going to probably take a bit of a hammering over this, but today's 0.25% increase to 0.35%. A big surprise, a supersized one, but also a very harsh reality check to people who may well have overcommitted themselves, believing rates would be staying low for much longer.
It's going to be interesting to hear from the Reserve Bank about exactly what Peter's been saying there, won't it?
Oh, absolutely. And, Australia is considered to have a debt problem because we have around about double our household debt to household income. But if you think back at the extent of the lending that took place last year, a lot of younger borrowers and first home buyers were given 6 times their income to borrow. And so that is an extraordinarily large increase or increment above double, which is considered to be a problem nationally.
Weren't banks meant to tighten up the criteria for lending?
Well, they were, and all through that lending spree, the Reserve Bank and APRA was saying that lending standards haven't slipped. But if you're lending 6 times income to people, that is really pushing it. And all the banks were out there competing against one another for market share. ANZ was probably the one that didn't compete as hard, and it was criticised roundly for it. The other banks all picked up a lot of extra loans as a result of that lending spree.
Final thoughts from you, Ian?
Thanks, Rose. Yeah, absolutely.
It's been a big day.
Yep.
Okay, Ian Verrinder, our business editor, thank you. So before we go, just to recap this breaking news, the Reserve Bank has increased interest rates for the first time in more than 11 years with a 25 basis point hike, and that takes the cash rate to 0.35%. That's ABC News for now. I'm Ros Charles. The ABC News channel will have continuing coverage of the rates decision throughout the afternoon, including news conferences from the government and from the opposition. So far, we know that the Shadow Treasurer, Jim Chalmers, is due to step up at just over an hour's time at 4 o'clock Eastern. And doubtless, of course, the government will also be putting up the Treasurer and the Prime Minister. We'll bring you those comments all live on the ABC News channel. But for now, from us, it's goodbye and thank you for joining us.